Dah siap. Pandainya. Murid-murid, sini. Kalau semua dah sedia dah untuk rumah terbuka kita? Dah. Jadi kita belajar sama-sama, Okey, nombor 1. Korang buat elok tau. Kalau tak ada remang lagi. Okey, nombor 3.
Puan, lot ini bos kami dah beli. Dia tak kasih buat aktiviti kat sini tau.
Apa pun tak nak.
Cik.
Cik, Pai! Sekarang ni tempat bisnes aku. Bukan tempat untuk kamu semua main-main. Faham? Aku dengar kamu orang tak letak dokumen yang lengkap. Tak tahu datang dari mana. Kalau mau belajar, kamu pergi cari tempat lain. Diamlah. Jangan buat bising. Dasar bagus sudah komplain.
Saya faham Cikgu Siti. Tapi budak ni tak ada sijil lahir, tak ada dokumen.
Tak bagi budak-budak ni pergi sekolah kan? Tak apa. Biar aku je yang dekatkan sekolah dengan diorang.
Boleh tak saya tukar apple ni dengan buku tu?
Yang ni? Boleh je. Nah. Tak apa, awak simpan je apple tu, okey?
Betul ke?
Betul.
Terima kasih, Kak.
Okay, so A untuk?
Apple.
B untuk?
Ball.
C untuk?
Cat.
Walaupun dia tak ada dokumen, Cik, dia tetap ada masa depan.
Peraturan tetap peraturan.
Kalau dah tak ada jalan lain, Cik, memang masa depan budak-budak ni tertutup selamanya, Cik. Budak-budak ni tak minta kemewahan. Diorang cuma minta peluang. Kalau maksud sebenar raya adalah untuk buka pintu dan hati, inilah masanya tuan-tuan dan puan-puan. Untuk kita buka pintu untuk mereka ni semua.
Bos, stok kita terbakar sebab ada orang buat rokok. Kita kena cari tempat lain.
Mr. Lim, saya nak jumpa awak ke rumah terbuka hari raya nanti.
Bukankah itu maksud sebenar raya?
Pergi! Pergi!
Dulu aku fikir sekolah untuk yang ada. Cikgu ajar ilmu untuk semua. Walau datang tanpa nama, di sini kami semua diterima.
Haji, bye-bye, bye-bye. Tempat ini tempat ini nama orang pakai je. Tapi jangan bising sangat.
Cikgu nak awak ingat satu pesan Cikgu. cikgu, okey? Ilmu yang kita ada, kita kena kongsikan dengan semua.
Tahun depan boleh tak saya ajar budak baru?
Boleh.
Terima kasih, cikgu.
I want one of my kids in Jockey to become the future. They can be proud of themselves telling that I'm the street children that came out from Putra Jockey. And I'm here to change humanity. I'm here to change how people live. Okay, done.
Good morning, everyone. Welcome to the Morning Kappa at 8 on Wednesday. I'm here to present the Midweek Futures Traders Technical Brief, and we are looking at week 2, March 2026. Again, we look at this very important table whereby the most popular products being traded by traders. And by looking at this table, we can identify that the indices are all in the negative territory, as well in a negative setup. This is all due to the war theme that's been ongoing and has provided much news to the marketplace and also increased volatility in most of the categories of assets we are covering here. One of the major beneficiaries which has seen very big momentum on the upside is the energy sector. Crude oil pierced through the $100 mark, but it has now retraced back to below that level. And the agriculture sector also saw a massive buying momentum, which pushed prices to new multi-week highs. And for our own palm oil, which we're now going to look at it, we too benefited from a major spike, closing, although it's closing below the major resistance. The high that was achieved on the active month was above the 4,800 level, and that has not been seen for many months. So this has also given a perspective that the war theme is truly a impetus for volatile trading. But I want to forewarn everybody, volatility may not be suitable for all. All of us who are traders will still have to put our stop levels and also to practice risk management in order to survive the volatility in case we are on the wrong end of the market. So on this slide, we move on to the commitment of traders for the US indices. This is, of course, the previous week for March 3rd, 2026 for all the US indices. And this may not reflect the true sentiment currently, but at least this would be a guide to show us that hedgers have already been very active hedging their positions, especially in the S&P 500, whereby we saw a massive jump in short positions. The other one that has seen a so-called increase in activity is the Nasdaq. Somehow or rather, the hedgers have unwound their hedging on the Nasdaq 100. For the micro side also, we saw the Nasdaq increasing in long positions. So therefore, the AI play may still be around for some time, and after the war theme has subsided, most likely this Nasdaq would have some impetus for some upside. So I think this is something we will look out for. But at the moment, we will focus on the Dow. And we can see that the Dow has been mainly affected by the fading hopes of an earlier than expected end to the US-Israeli war on Iran. But also we have a backdrop of ongoing worries of economic stagflation. So for the Dow and also our market guide for the 11th of March, we have got a short-term setup which is positive, whereby we are looking for a potential reference price at 47,000. Currently is 47,920, and the potential profit price we are looking at is at 48,250, which will give us a value of $625 US. And in case things go sour, it will be below the 46,630, which is the potential loss of a value of USD 350 US. Moving ahead, we have the commitment of traders on metals. So metal is unique in the sense that this round of surrounding the war theme, it has been lackluster, and basically we saw on the so-called table on the first page, right? We noticed that most of the metal are in neutral positions, and we therefore want to recommend for copper this round, because it is in a range-bound situation. We will want to be focusing on this particular product. Basically, what is surrounding copper is the tight conditions supporting copper prices in recent months have started to ease. And copper prices have also come under pressure recently as macroeconomic headwinds combined with softer and physical demand signals. And these signals include rising exchange inventories and also softer Chinese import demand. And on the macro side, higher energy prices and also a stronger dollar are among factors that are weighing on the sentiment for copper. So for copper, short-term setup is negative, and of course the profile currently is neutral as mentioned. So current price is at 5.95, and we are looking at a reference price of 5.86. Potential profit price is below the 5.70, which will give us a US dollar 400 and also a potential loss of USD 250. So this is a promotion that we are having right now. It is a campaign whereby all new accounts open with us, we will give you a 500 ringgit zero brokerage on the buy side for 30 days. And this campaign, the Trade with Passion campaign, will last till the June of this year. So take advantage of this campaign that we are offering to you, and happy trading when you open the account with us. And that 500 ringgit zero brokerage will be all yours. So this is all I have. I'll pass on to the next speaker. Aiman, over to you.
All right, thanks, Vincent. Good morning, all. Okay, so if you look at the S&P 500 yesterday, right? But it closed slightly lower. I mean, down about 0.2% to close at 6781 points. So I think it was much a calmer day yesterday as compared to the Monday chaos, right? So I think while the oil prices have stabilized at lower levels, I think those investors staying cautious because of the situation on the Middle East is still very unpredictable. So I think most of the market is now holding its breath for the CPI coming out later tonight, as that will give us the best clue about where interest rate is headed. So I think on the bright spot today was the healthcare sector, particularly I mean, this one, Vertex Pharmaceuticals, which surged over 8% on positive drug trial news. So I think for today, for the coming session, we expect the market to stay at least range bound until the inflation numbers release, right? So if you look at the China A50 futures, so it finished higher, slightly higher on Tuesday session, gaining 1.4% to close somewhere around 14,718 points. The market successfully rebounded as investors shifted their focus away from the war panic towards the strong domestic trade data and also the optimistic signals on the ongoing political meeting. So from my side, we expect a firm and positive opening in coming session as the market attempt to maintain this kind of momentum moving forward, breaching this 40,700 resistance level for now. Also, today we have Hong Kong trading stocks. Right, so firstly, we have a KESO, a stock code 9926, which is a healthcare related counter, specifically into those, the cancer, the biopharma cancer products. So the stock is on its breakout formation and reach above this 112 Hong Kong dollar resistance level. So if the bullish momentum to remain steady, we can expect the price to test the next resistance at 122 Hong Kong dollar. And before it climb further or higher towards the 132 Hong Kong dollar level. So now if the momentum to reverse, make sure to have a stop loss at 105 support level. So up next we have Kingboard Laminates, stock 1888. So if you see here, the stock is now eyeing to climb higher after this rebound from the 21-day moving average. And now if the price is able to continue to maintain higher, it may breach this 23 and reach 24 together with 25 Hong Kong dollar level. So a reverse below 22 dollar level will open the door for a deeper correction, which also might shift the trend. So now we have one breakout and also one pending breakout for 1888. Right, so looking at the WTI crude oil futures, well, actually, we saw a slight rebound yesterday or Tuesday session, which also at 1.59% to settle somewhere near $86 per barrel. I mean, it rebounded from the scary intraday low of $76 as some said that the massive war bubble began to pop. But However, we do expect an extreme volatile to continue at least into the coming one or two more sessions, and also sensitive opening in the coming session as the market reacted. I mean, to react, shifting headline between uh, the de-escalation hopes and also the ongoing military strikes. Also, if you look at the Malaysia market, right, the KLCI and also the FKLI were both staged a strong rebound on yesterday with the FBM KLCI index gaining 27 points or 1.64% to close at above this 1,700 points. I think the market successfully reclaimed the 1,007 psychological level as the global sentiment improved following the signal from the president, the US president, of the potential de-escalation in the Iran conflict. So I think at least in the Asia market, expect a firm and steady opening in Wednesday session or in the coming session as investors continue to digest positive domestic economic data and the newly launched five-year capital market master plan for our local market. And also for the FLI, I mean, yesterday we have revised our support down to 1615 and also 1570 after the breakout. And also for now, we keep our bearish bias unchanged with stop loss of 1720 level. I think for Malaysia market, we saw a broad-based recovery from yesterday's move led by our banking heavyweight, the Maybank, Public Bank, and also CIMB all posting solid gains as investors cheered a potential easing of the geopolitical risk in the Middle East. I think although some energy and also the plantation stock like hibiscus, yesterday we have United Plantation, right? In this lagged due to the retreating oil prices. I think the overall market breadth was overwhelmingly positive with over I think more than 900 gainers, right? So it is a classic race on the session today, supported by further Malaysia resilient manufacturing growth as well. If you see here, standout performers on the broader market include, we have Nestle, we have AX, right? And Capital A as well, KPJ as well, for the health and services. And talking about AX, right? I've been receiving a lot of questions regarding my view on this AX. So I believe that it has found its support at 97.5 cent recently. Following the significant drop, and now I think it is a phase of rebound, right? So if you look at the daily chart, I believe that this is just a false breakout resulting from the sentiment of war. Now that it has tested this 129 cent, 129 or 130 cent level, I think I believe that there is still some room for the counter to propel higher towards 167 cent resistance, and based on this daily the touches of the support resistance, right? Also bear in mind 129 cent is the weekly support level, which I do believe that this is the significant key level as well. So let's see whether after the bargain hunting begins, whether the price able to climb back up higher to test the immediate resistance for now, which is the 167 cent level, right? Also for today, our Malaysia trading stocks, we have Westport. So the stock is in its breakout formation, here at 6 ringgit level on strong volume. So with that, we expect the momentum to keep bullish and the stock able to propel higher to test the next resistance at 2 ringgit and 25, 6 ringgit and 25 cent, followed by 6 ringgit and 45 cent levels. Support is back at 5 ringgit and 80 cent level. And also next we have Guangzhou. So the stock is experiencing a breakout as well at 75 cent level. Next resistance is at 79 cent level, followed by 83 cent level. Q&I at the 71 cent level for any attempt of the reversal. So we have two breakout stocks for today, which is Westport and also Guangzhou. Right. Lastly, for the FCPO, well, it retreated sharply on Tuesday session with the May delivery contract dropping to 139 ringgit to close at 4428 per ton. So I think the market gives back a significant portion of the Monday gain as a nearly 6% crash in the crude oil prices. Could the war panic and trigger the widespread profit taking? So I think I expect a cautious opening, at least a movement in Wednesday session as traders weigh on the newly released MPOB data against the retreating energy market. Right. I think that's all from me. Pass the floor to the next presenter. Thanks everyone and happy reading.
All right. Thanks, Aiman. So good morning, everyone. So I would like to give a brief update on Malaysia IPI report for the month of January, which was released on yesterday. So we're still seeing that the January IPI still remain robust, where it increased by 5.9% on year-on-year basis, which is higher than December's print of 4.8%, and also higher than our in-house projection of 4.6% and Bloomberg consensus estimate of 5%. So in detail, it is actually driven by higher output from the manufacturing sector, where it rose by 7.3%, while the mining sector production actually also inched higher by 0.1% on year-on-year basis for the month. So the manufacturing sector output is basically supported by increased productions of E&E products, food and beverage, as well as non-metallic mineral products and metal-related products as well. So for now, we still maintain a sanguine outlook for Malaysia manufacturing sector in this year due to resilient domestic demand and continued strength in external demand amid a favorable regional growth environment. So our in-house IPI projection stands at 4.1% in this year, up from 3.6% in last year. Nevertheless, we still exercise a degree of caution regarding the uncertainties from the external front, particularly stemming from evolving geopolitical tensions and also potential changes in the US tariff policies. So domestically, we're still seeing that resilient private consumption and investment activities are expected to continue supporting the industrial activity, with the policies promoting local production and SME development should strengthen a domestic supply chain as well. So meanwhile, export-oriented industry are poised to benefit from positive external demand outlook amid higher global activity and robust E&E demand. The global technology upcycle will still continue to bolster the E&E cluster as well. So while we are broadly optimistic about the Malaysia manufacturing outlook in this year, so we're still seeing that the uncertainties surrounding the global trade policies and current geopolitical tensions in Middle East do warrant close monitoring as well. So as per our preliminary analysis, we are seeing that the direct impact of the Middle East geopolitical tensions on Malaysia exports and manufacturing sector is expected to remain limited, given the country's relatively low trade exposure to the region, where trade with Iran itself, it only accounts for around 0.1% of Malaysia's total trade, while the trade with the broader Middle East region represent approximately 4.2% of Malaysia's total trade. So on the inflation front, however, our correlation analysis do indicate a statistically significant coincident relationship between the Brent crude oil and LMEX prices and Malaysia's producer price index. So in another word, so these do suggest that there will be some potential upside risk to production costs due to the higher crude oil and metal prices when we compare to the start of the year. So in a more adverse scenario, so a prolonged escalation of US-Iran tension might have some impact on the global growth and trade, which will weigh on Malaysia external demand and potentially affecting the investment income flows as well. So separately on trade itself, so our assessment do suggest that the transition of US reciprocal tariff policies to Section 122 do offer some advantages for Malaysia, where currently we were having a lower effective tariff rate at around 3.6% under the current 10% regime, which is lower than the 6.6 effective tariff rate under the previous 19% tariff. Most of Malaysia key export to US, particularly from machinery and electrical products, still remain largely unaffected under the new regime and is still within the exemption list, but under Section 122 of the Trade Act of 1974 as well. So beyond the IP prints, so we also seeing that manufacturing sales also remain robust and expand by 7.1% in January as well. So that's all from me. I will pass the stage to the next presenter. Thank you.
Hi, thanks, Yee Sian. Good morning, everyone. So today I'll be presenting on the sector update on the plantations on behalf of Lilang, where I'm going to talk about the impact of war on the plantation sector and the monthly statistics that was released yesterday. So firstly, the current war in the Middle East has multifaceted implications for the plantation sector with both positive and negative effects. Let's talk about the positive side first. The most immediate impact has been the sharp rise in crude oil prices. As we have seen that since the war began, the crude oil price have increased by around 30%, while it's also pushed the CPO prices higher by about 12% over the same period. So at this point, we are seeing very high correlation between the two oils, where the correlation now is at 0.92 times as compared to 0.43 times in full year 2025. And another thing is the narrowing of the POGO spread, which has declined to around $20 per barrel as compared to $52 per barrel at the beginning of 2026. So at this low spread, we estimate that the Indonesians Biodiesel Fund could potentially have sufficient resources to support the B50 mandate, even at the current export tax and levy rates. So if Indonesia proceeds with the B50 implementations earlier than expected, so it could remove around 4 million tons of palm oil supply from the global market, which could be supportive for the CPO prices. And if the POGO spreads turns negative, we could also see the return of around 3 million tons per year of non-discretionary biodiesel demand. So that's on the positive side. On the negative side, however, the main concern is the potential disruptions of shipping routes near the war zone. So based on the oil world data, countries such as Pakistan, Egypt, Saudi Arabia, Turkey, UAE and Iran could potentially be affected because this market collectively around 50% of the global palm oil demand. So any prolonged disruptions could impact trade flows. And although that we think that the shipments can be diverted through other alternative routes, but this was definitely would likely lead to higher freights and logistic costs. Another risk is related to fertilizer supply. The Strait of Hormuz is a key route for the global fertilizer trade, with roughly around 1/3 of the world's fertilizer shipments passing through this route. So any disruptions could therefore increase fertilizer costs and indirectly affect the edible oil productions globally. So far, that what we have seen so far is the increase in fertilizer prices on average is only about 1.6% since the start of the war. So so most planters that usually they would secure their fertilizers requirements for the first half 2026, and the first fertilizer tenders are usually done twice a year. Therefore, we can only see the impact of the increase in fertilizers starting from second half onwards. And now we think that fertilizer cost accounts for roughly around 20 to 30% of the total oil production cost. And lastly, on risk is on the rising logistic and insurance costs. So currently, the global freight rates are already at all-time highs, and the insurers, since the breakout of the war, the insurers are preparing for the possibility of activations of notice of a cancellation provision in war risk policy, which we think that this would lead to a sharp increase in war risk premium. So if this happens, the shipping costs could rise further, increasing the overall cost of transportations of the palm oil. So that's on the war. So moving on to the latest monthly statistics. So in February 2026, Malaysian palm oil production declined 18.5% month-on-month to 1.28 million tons, although it was still 8.1% higher year-on-year. So this month-on-month decline was mainly driven by Sabah, which fell 22%, followed by Sarawak, which fell by 19.3%, and lastly, the West Malaysia by 16.3%. However, looking ahead, we still see that productions should continue moderating as the industry is now entering a seasonally low production output. On the export side, Malaysian palm oil export declined 22.5% month-on-month, although they are still 13.2% higher year-on-year. So the month-on-month decline was largely expected because of first is seasonal factors. Second, there's still relatively comfortable stocks levels at importing countries. And the third one is a shorter month in February. So going forward, we see that the demand could improve because the CPO is currently trading at a wider discount as compared to soybean oil at 308 USD per ton, as compared to previously it was traded at only $233 per ton. So this should encourage buying from price-sensitive countries. So the Malaysian Palm Oil Council for Feb 2026 is not yet available, but as you can see, the major importing countries like China, India, Pakistan's January palm oil stocks level rose to 32%, 75% and 22.5% higher than their 5 years historical average in January 2026. So we think that buying activities may lean towards Indonesian palm oils given its more advantageous tax structure. And then finally, in terms of the sector view and price assumption, given the current situation, we are maintaining our neutral weighting on the plantation sector because we feel like we are still facing a high level of uncertainty due to heightened geopolitical risks. So therefore, we maintain our CPO price assumption for now because we feel like we need to wait and see whether how the Middle East war will conclude or potentially extend further, because we afraid that the CPO price will rise and quickly fall as what we have seen in the Ukraine-Russian war in 2022. So we maintain our neutral sector weighting and CPO price assumption of 4,250 ringgit per ton for 2026 and 4,100 ringgit per ton in 2027. Our top pick remains JPG, SDG, Sarawak Oil Palms, IOI, London Sumatra, and First Resources. That's all from me. Happy trading and see you all tomorrow. Thank you.